Hello everyone, this is Tim Davis coming to you guys from the Bullish Bears team again. And again, like I said, I'll be recording this video for our YouTube users. And this video will be a recording documenting the short call ladder. So my review and my explanation of the short call ladder option strategy. And for you guys who don't use this tool, this would be a good tool to use if you really need further clarification and explanation in reference to certain strategies. The optionsguide.com is a good resource for you to use. So the short call ladder or bear call ladder, which is sometimes referred to, is an unlimited profit, limited risk strategy in options trading that is employed when the options trader thinks that the underlying security will experience significant volatility in the near term. And it's constructed with a call, an in-the-money call that you sell. So you sell one in-the-money call, you buy one at the money call, and you buy one out of the money call. That is how you construct your short call ladder. And this short call ladder, like I said before, it has limited downside with unlimited upside profit potential. So less risk, but you do not limit your upside potential like you would do in a straight call spread. So maximum gain for the short call ladder strategy is limited if the underlying stock price goes down. In this scenario, maximum profit is limited to the initial credit received, since all the long and short calls will expire worthless. So you can also receive a profit on the downside to a certain extent, and I'll show you guys that in the example that I'll use. However, if the underlying stock price rallies explosively, potential profit is unlimited due to the extra long call that was purchased. And here it shows you a formula for calculating the profit. But I want to go to one of my famous tools that I like to use. It's the options calculator, and I'm also show you guys the Thinkorswim version of where you can actually see the calculation of the profit, as well as the break-even points. But this is how it's constructed. As you can see, here's your diagram here, and you can look at this at your leisure at theoptionsguide.com and looking up short call ladder. And here it has an explanation of your limited risk. Losses are limited when employing the short call ladder strategy, and maximum loss occurs when the stock price is between the strike prices of the long calls on expiration date. So between the strike prices of the two long calls at expiration is when you could possibly receive maximum loss. So if the price of the stock lands between those two and sits there at expiration, you can receive maximum loss. And say the maximum loss is, again, the distance between the strikes. At this price, the higher striking long call expires worthless, while the lower striking call is worth much less than the shorter call, thus resulting in the loss. And it gives you the formula of how it's calculated there. And it also gives you the formula for the break evens. But now what I'm going to do is I'm going to go to the options profit calculator, and we will construct a short call ladder example. That way you can see how it's constructed. And the options profit calculator also has some unique tools in there where you can see your profit and loss in a unique diagram, and I'll show you guys that here in 1 minute here. All right, so it's selling in the money call, buying an at the money, and buying another out of the money call. So it's a three-legged position. So I'll come over here to where it says custom. I'll click on 3 legs. And the example I'm going to use today is going to be with MET, MetLife, And all I need to do here is, since one leg we're going to sell, I'll change this first leg to a right within the options calculator. And the other two should be at buy, and they already set it buy. So we're going to write or sell one in the money call. So we're going to do this with the May contracts. And so on the options calculator, again, for you guys who have already reviewed my previous video on the options calculator, you will understand how to use this tool. If not, you can go and find my video on the options calculator. You can find out how to use this tool. So we're going to buy one in the money call, and we're going to sell one at the money call and one out of the money. So for this purposes of this example, I'll just say that $45 is the at the money position. So we're going to sell the 42.50 call here. We will buy the 45 call here, and then we will buy another out of the money call. We'll make that the 47.50 here, all expiring the same month. Okay, once you have that set up, you click on the calculate button. And here you will be able to see, and it calculates it for you, so you don't have to do all the calculations on your own. You'll be able to see here that the entry cost for this trade is a net credit, because you are pretty much setting it up as a credit spread. So you're taking in a credit. Maximum risk, $121 when you're using a credit spread. You normally have to have some type of margin or collateral. So that's your maximum risk here, 121, and that should be easy to figure that out. At expiration, that is. So 121 is your max risk at expiration if the price ends at $45. Maximum return is infinity. So you have no upside cap. Upside potential is unlimited. Shows you the break-evens here, break-even at expiration. So because you can profit on the downside or the upside, it has an upside break-even at 48.70 and downside break-even at 43.80. And if you look at this diagram, which I'm going to show you next, I call it a heat map because I like the way it's set up. So this is a unique thing about using the options profit calculator to determine where your loss and your profits may be at expiration and before expiration. So here, as you can see, if price hovers around that $45 level and stay at that point all the way to expiration, as you can see, as I move this cursor over, you can see where you could end up with max loss if we stay between a certain price range. So looks like here you can receive max loss if price stays between $47.50 and $45. You can receive max loss there. Anything outside of that area, you will not receive max loss, but depending on where you land, you could probably still see some kind of a loss. So the ultimate goal is to get out of this range, which is like this little red area range, to get out of that range and be out of that range at before expiration. So here, as you can see, if price continues to go up, you can profit. And as you move the cursor around, you can see what your profit could possibly be if you end up in that area. Now, one thing you won't see here, because this price diagram only goes up to $52, anything above 52, you would know automatically that you're also in the money and you will receive profit. Now, below this area, this red diagram area, you'll also see that you can profit if the price of the stock trickles lower as well. So that's what makes this short call ladder a very, very good tool to use. Because you limit your downside risk. Downside risk is limited, and if you go too much lower, you can also profit. So that's what makes this short call ladder a very, very good tool to use when you expecting some type of move to the upside in the long term. But if it doesn't go your way, you can also profit if it falls well below your lower strike. Okay, so that is how it looks here. So that is an explanation of the short call ladder. Now, for you guys to use Thinkorswim, you can also set it up there as well. And we're going to set it up in Thinkorswim now and show you what it looks like over in Thinkorswim as well. So this is a very good strategy if you're bullish on a particular stock. You don't want to and you don't want to trade a naked call, because you know with the naked call, you have a little bit more risk involved there, and also your break evens. And your naked call also is hurt by time decay. So if time decay, can go against you whenever you're doing naked call. So this is a better way to trade a bullish position without getting a naked call. So in Thinkorswim, for some reason, I've been looking for this and haven't found it yet, but I don't see a customized button. So what I did was I just modified a butterfly. So I'll modify a butterfly here in order to get this short call ladder set up in TOS. So you just come over to where it says butterfly. Once you click on the bid, and it's going to bring up the credit setup for selling a butterfly. You just click on that section where it says butterfly, click on custom, and then you'll have to come here. So we're only going to sell one position, so the other two will be buy. So we click on buy here, and we change this middle one from since it was a butterfly, you got to change this to a plus, so +1. And we did 42, 45, 47, so that is correct. And we are selling one call and buying two other calls. And I think the expiration I had originally was May, so we'll stick with May. All right, we got that changed to May. All right, so it's set up properly, got it customized. We're going to sell one in the money call. We are buying one at the money call, and we are selling one out of, buying another out of the money call. And for Thinkorswim, you hit your confirm button, and when you hit your confirm button here, another box pops up, and it shows you your break-even price. It's the same as it does on the options profit calculator, and it shows your max profit, and it says infinity. Your max loss here, it shows you your max loss, which is 120, and it shows you, if you do use Thinkorswim, your cost of the trade, including commissions, and your buying power effect. And you can also analyze this trade on Thinkorswim by coming all the way to the right, hitting this little menu button here. Click the Analyze tab, and you can analyze this. I like to set the slices at the for the break-even points at expiration, so those are set. So anywhere between these two long strikes, outside strikes, you will incur some type of loss. Okay, and the loss increases as it gets to the center point here of this particular diagram. But once you go on the outside of these two break-even points, as you can see, you'll start to see a profit. Now, to the left, which is the downside, you'll see this profit will be capped off at a certain point. So right here is where it's capped off, and you can see the profit diagram over to your bottom left corner, where you see the light blue and the pink. Look at the light blue area price. That is your profit to the downside. And on the upside, as you can see, if we continue to let's see if we can do this, move this around a little bit. Yeah, I do want to do that. So if we move this around a little bit, and as you can see, as you continue to go higher on the upper side, you'll see that your profit is unlimited because it keeps going higher and higher and higher. So the upside profit is unlimited, downside profit is capped. All right, so that is my explanation of the short call ladder, and that is the setup that I like to use for bullish positions that I believe has unlimited upside potential in the near term. I'll use that instead of the actual straight call. All right, that is my video for this. Hope you guys enjoyed this. Please check our website out, www.bullishbears.com, and you can find out more about us. And the dog is calling, so I'll be finishing this video now.